I have been in the real estate landlord business for over 20 years. And during those 20 years, I've owned as many as 115 rental units. That's right. But along the way, after expansion, we decided to contract. And now we are down to only 8 rental units. So 20 plus years in rental real estate. And I now have a whopping, 10 months worth of selling options experience. And in that time, I've come to a conclusion. Which is better, rental real estate or selling options and collecting dividends? Drum roll, please. Ryan Seacrest, dim the lights. And by far, and every day of the week and twice on Sunday, bloody Sunday, selling stock options and collecting dividends beats the pants off of rental real estate. And I wanted to give you a very specific example. So this is one of my sweethearts, Devon Energy, ticker symbol DV and the N. And this is just essentially a random example. I like to keep track of my positions individually as well as daily. Okay, we got all that going for us. So let's take a look at Devon Energy with this position beginning around March 8th, 20 and the 23 on the Mayan calendar. Bought 200 shares that day. On March 10th, bought 200 more, 200 more shares on the 15th. And then up until this week, and that's all that this current spreadsheet is based on as far as this example. I did buy 300 more shares this week, today, and I believe yesterday, but we're going to base it on the 1,300 shares prior to that, with an average of $52.80 per share for $68,640. Now, during the last 5 or 6 months, Devon Energy has just kind of bounced around, probably from $48 to $54. So it hasn't done much. In fact, today it closed at around $50.65. So you can see it closed under what I have into the stock based on the original 1,300 shares that we're basing this example on. But we sold some calls, collected some dividends, rolled a lot of calls, and here is the premium we collected for doing all of this, okay? $375 on a call. We bought it to close for 19. We sold 11 call contracts, covered calls, which would represent 1,100 shares because it's 100 shares per one options contract. We collected $801 in a dividend on March 30th, rolled the calls for 792, rolled them again for 176, 132, 319, $55 bills. Sold calls again for $99, 2 more for $34, collected another dividend at the end of June for $792. We had a call on July 3rd, 11th, and 21. Rolled it again on the 28th, again sold it on the 9th and the 25th, all of which added up to $6,959 in actual cash in my pocket. Okay, so $6,959 cash in my pocket. And in doing so, it was approximately 100. Let me move my big head. Move that melon out of the way. So it was $6,959 divided by the original investment of $68,640, divided by the 184 days that we've been in the trade so far. So this will continue, but this is just basically up until today, as far as 184 days in the trade. And then we multiply that to annualize it by 365 days, which gives us 20.1% return. Now, keep that number in the back of your head as we move to a pretty typical rental income or residential income scenario. So I'm not saying that I can get a house for $68,640, but we're using this example because that's what we have into the Devon Energy stock position. Now, in my real estate investing career, we used what we called the 1% rule of thumb. And if you were able to buy a house that you can then rent out for that value per month, then you're doing pretty good. 1% rule. Okay. So, for instance, in this case, if we bought a house for $68,640, and you still can, there are some places, a couple little spots in Valparaiso, certainly surrounding areas where we can get a single family home for $68,640, rented out for $687 a month, which would be the 1% rule. Multiply that annually, you'd end up with $8,244 in rent. Not so bad, right? Yeah, not so bad, but not so fast. Now, in my investment career, I always use the fairly conservative rule of thumb as well with regard to expenses. Okay, so I would use a 50-50 rule, which would be I would take 50% of this total. Like if I was evaluating a rental investment, and I'm not saying I'm completely done with rentals, I'm not. If one falls into my lap and has the right valuation, I would probably consider it. But at this moment, I'm not actively looking. But I would typically do is I would determine our number. We'd end up with the $8,244. And then I would cut that in half and I would consider that to be my net before paying income tax. So we've gone even more conservative, or I should say aggressive, just for this example. And I subtracted 40% from that total, which would be $3,298, which would then accompany or pay for and accommodate property taxes, insurance, maintenance, because there's always going to be that toilet that needs to be replaced or repaired, or the furnace goes out, of course, on the coldest day of the winter, or the central air unit on the hottest day of the summer, and then vacancy. And, in our area, I would say we got pretty low vacancy, probably around 95, 96% as far as occupancy, which would be 4 to 5% vacancy. But all that needs to be accounted for. And a lot of real estate investors don't. They don't even, they might consider property taxes and insurance, but they never consider the maintenance and vacancy over the long run. And that's just a mistake. So that leaves us with $4,946. And then I moved the income tax number down to 25% because there are tax advantages with regard to rental real estate. In fact, we can depreciate some of the value over the course of just under 30 years and use that number per year against our income taxes, our taxable income. So what I did was I took 25%, which would be payable in income taxes, which is $1,236, which leaves us with $3,710. Now, if we take the $3,710 divided by our investment of $68,640, we're left with 5.4% net income. Not something you hear about in the late night real estate infomercials, is it? Now, again, this is unleveraged, okay? So you will hear guys like Robert Kiyosaki from Rich Dad, Poor Dad, and others that would say use other people's money, aka the bank. But right now the bank's going to cost you 7.5% to 8% on a rental real estate mortgage, even when considered a residential, which is considered less risque for the bank to take on that. Yes, move your head to the corner. Maybe that'll be out of the way. So then we go back up to our Devon Energy with regard to our dividends and our options premium that we collected. And now we annualized the number, okay? So we did annualize it to return 20.1%, which would be on $68,640. That's $13,797 that we will approximately, now we're going to keep this spreadsheet and I'll update it again once we're exactly 1 year into the Devon Energy trades. But then I applied 30% income taxes for $4,139, leaving $9,658 bills, which gives us a net return of 14%. So nearly 3 times as profitable than our 5.4% net return on our rental real estate. And guess what? No tenants and no toilets to deal with. So we have that going for us. I just wanted to share what I was thinking of today when I was updating my Devon Energy spreadsheet. I was thinking, hey, for all the years I did real estate, and believe me when I tell you, real estate is the greatest small business opportunity in the world, especially when you couple real estate sales with real estate investing. Those two things put me in a favorable position that I am able to trade stock options now, collect dividends, and not have to deal with nearly as many tenants and toilets as I used to. Just wanted to share that thought. Let me know in the comments below if you're following, if you're tracking with this example, and if you have any history with rental real estate and also trading and selling stock options and collecting dividends, what your current thoughts are on that. Thanks for watching. Subscribe, like, comment, and I will see you in the next video.